Hello and welcome to our Business Management Unit 7. In this unit, we are talking about business finance, which is definitely a very important part of business management. So let's get right into it. This is lesson 7.1. We're talking specifically about business finance. So our objectives for this lesson are to define the purpose of business finance, describe the role of a financial analyst and their part in making companies more profitable, and to explain the difference between solvency and insolvency, and finally to describe the difference between assets and liabilities and provide examples of each. So let's get right into it again. So business finance, the definition of business finance is the process of acquiring or managing the funds needed to run a business or make it profitable. They help determine profitability and manage costs. And companies employ financial analysts to ensure that they are making good financial decisions. And businesses use financial analysts like detectives to track their money and ensure healthy operations. And the field of financial analysis is rapidly growing, and professionals entering the field in the United States can expect to earn a median salary of $91,000 per year. Now that's according to Indeed.com in 2024. So what do financial analysts do? What specifically do they do? Well, let's kind of look at a possible job description, a job posting. So here we go. Financial analyst. Their duties include recommending investment sources and managing portfolios, evaluating current and historical financial data, forecasting operating income, analyze company assets and liabilities to determine value. They recommend budget changes, and they prepare financial reports for investors. So let's talk a little bit more into this, get a little deeper. So financial analysts recommend investment sources and they manage the portfolios. They find new investors for the company and maintain existing ones. And companies will use the invested money to grow and to expand their business. They also evaluate current and historical financial sales data. They look at the past and the present sales for products and services. Companies will need this information to find out if they or their products will be profitable. They forecast operating income. They find out how much money the company has to operate. Companies use the money that they earn minus the expenses to keep the business operating. Financial analysts also analyze company assets and liabilities to determine value. They find out how much the company owns versus how much they owe. This is done by subtracting the company's liabilities from their assets to determine their value. They recommend budget changes. They help determine if a company needs to change their budget because of increases in income or expenses. Companies need to make sure that they are bringing in a profit and not spending too much money. They also prepare financial reports for investors. These show investors the profit and the value of the company. Companies use these reports to find new customers and keep existing ones happy. Now, one of the jobs of a financial analyst is to ensure that the company retains solvency and avoids insolvency. So solvency is the ability of a business to pay all of its financial liabilities with its projected assets. Insolvency is when a business is unable to pay its financial liabilities with its projected assets. So financial analysts also determine the company's value by calculating the assets and the liabilities of a company. Now, these analyses help ensure that the company remains profitable and continue to operate without going bankrupt. So assets and liabilities. Assets are items or monetary amounts owned by or owed to a business. It includes cash, accounts receivable, prepaid expenses, inventory, furniture, machinery, an empty building, land, a company car. All of these are assets. On the flip side, liabilities are incurred costs that are owed by a business. They could be credit card payments, lease payments, tax payments, cell phone bills, an invoice from a vendor. You have to pay the vendor for what they provided you. A line of credit, employee salaries. These are all liabilities. So it's the difference between assets and liabilities that help determine the profitability and the value of a company. And so that is our lesson 7.1 on business finance. The objectives of this lesson, again, a quick reminder, were to define the purpose of business finance, describe the role of a financial analyst and their part in making companies more profitable, explain the difference between solvency and insolvency, and describe the difference between assets and liabilities and provide examples of each.